Welcome. I'm Reed Kramer. I direct our asset building program here at the New America Foundation, and it's a pleasure to have you here with us this morning for this discussion. A lot of our work in the asset building program explores innovative ways to promote social development and economic opportunity, especially by creating pathways forward through savings and helping families build up an asset base. And of course, the Great Recession made the asset building process much more difficult for many households, particularly those that were increasingly exposed to an array of asset stripping financial services, products that were high cost and low quality. In recent years, we've seen Main Street that's really been inundated with a bunch of peddlers of these products, complex products. They were sold as easy credit to consumers that often didn't understand their basic terms. And we've really seen the runaway growth of this alternative fringe sector, and it's been made up of payday lenders, purveyors of subprime mortgages, check cashers, really dotting Main Streets all over the country. And this sector emerged largely without any oversight, any regulatory oversight, because these products were sold by non-bank providers that didn't have federal regulators kind of set up in the system. Eventually, these loose lending standards spread elsewhere in the economy, and you had poorly underwritten subprime mortgages that were then packaged together, sold off to investors without much oversight. Often they were sold in highly rated securities, which made the problem worse and spread. So the end result was destabilizing not only for individual family household balance sheets, but also the entire economy as a whole. And I think we've learned the hard way the ways that what happens on Main Street connects with what happens on Wall Street and vice versa. And this is one of the reasons that the financial reform debates have been so consequential. There's certainly been evidence that we need greater protections for consumers, and we need new kind of codes of conduct and standards for the practices in the financial sector. So obviously, this timing of this event today is quite it is timely. The bill that's been debated this year in Congress, the Dodd-Frank financial reform bill, which has often been described as the greatest overhaul of the financial sector since the Great Depression. It appears to be poised to be soon to be law of the land. Maybe someone here has some late-breaking news they can share with us if that's not going to happen, but it appears to be on track. And for months in this discussion, we've been saying that the details of this bill will matter. Well, now it looks like we have some details to consider, and the bill addresses both what's happening on Wall Street and on Main Street. Among other things, it creates two new regulatory bodies that are designed to prevent what has happened from ever happening again. And then the question is the bill capable of doing this, and how so? And so these are the questions that we're here today to consider. Certainly the year-long legislative process has been one for the history books, and I believe, though, that we're actually at the beginning of a process rather than the end of one. You're going to have these two new authorities created, and I think we might title this bill The Rise of the Regulators, because you're going to have a newly created Council of Financial Oversight that's tasked to end too big to fail. You're going to have the creation of a Consumer Financial Protection Bureau, which is going to be tasked to be a powerful watchdog, which for the first time will have a unified single agency that's empowered to look out for the latest scams and gimmicks. And nothing in the bill actually mandates that this fringe sector has to shut down and close up shop, but the potential is there. One of the things I've liked to emphasize in this debate is how the bill creates language that actually changes the framework of accountability from one based on disclosure of the terms of a financial product and service that a household might get to one based on principles. And I think this could be a very significant paradigm shift for the financial services marketplace. And if the transition occurs from this disclosure regime to this principle-based regime, and products are sold and marketed based upon their fairness, their simplicity, their transparency, I think that's really a potential game changer. So it should benefit consumers. Common oversight should help level the playing field, so it won't matter if someone's getting a service from a bank or a non-bank. And this kind of regulatory consistency should actually help everybody in the sector. So there's a lot of shoulds, actually, in this discussion. And I think what we're here today to examine is whether or not this bill has the potential to really change the game in some meaningful ways, and do so on Wall Street and on Main Street. And like all oversight, effectiveness is going to be achieved through competence and vigilance and empowerment. And in many instances, the bill appears to create some tools that can do this, but they're going to have to be deployed. And we're really not at the end of the road, but we're at the beginning of a major construction project. And the next step is to find some general contractors who actually can go ahead and do the work. So these are my general contractors. These are the people that I think have something to offer and weigh in. So we've packed this session full of experts who can help us understand different aspects of this debate. And individually and as a set, they've really all played a role in this process. And they've helped policymakers understand what's at stake, and they're going to help us understand what comes next in this construction project. So we're going to hear from each of them, and then we're going to engage in an extended round-robin discussion. They're going to share what they like, what they don't like about the bill, what will happen of consequence as soon as it's signed into law, what potentially might not happen that's also of consequence, what some of the opportunities are, and what bears watching over time. Their bios have been available in the handouts, but let me give some quick introductions here before we dive in. Let's see. Tim Fernholz is staff writer for the American Prospect and also a research fellow in the asset building program at the New America Foundation. And he's been covering a lot of the financial reform debate, not just the TikTok politics, but also the substance of policy. We've been featuring a lot of his work on our blog, The Ladder, and it's been very informative. Travis Plunkett is legislative director of the Consumer Federation of America. He's been a major force in deliberations, and I have this on from an authority no less than Barney Frank, who has sung Travis's praises and importance in the process, shaping especially the consumer protection provisions. Heather McGee is the director of the Washington office at Demos, which is one of our think tank colleagues. They're based in New York City, but we're pleased that they're expanding their presence here in Washington. Heather's added a lot of value in many policy discussions along the way. She helped staff up John Edwards' policy shop during the 2008 campaign, which, as I think you recall, was consistently putting out some of the best, most detailed, far-reaching policy proposals, including early calls for a consumer protection commission. Mike Conzel is a let's see, what's your title now? You're a fellow at the Roosevelt Institute. Formerly, he was a financial engineer, and I'm not sure that's a good thing. I'm not sure what that is. But it's enabled him to have a really insightful view and perspective on some of these developments, what's at stake in this bill for Wall Street. A lot of his writings have been helped translate a lot of material into very clear language, so it's really been a go-to site. Rorty Baum is his blog, where he's been writing among other places, and he's been a real resource. Leslie Parrish is a senior researcher at the Center for Responsible Lending. We previously worked together here in the asset building program and a number of years ago, and she's gone on to do great work at the Center for Responsible Lending, being a major resource and expert in the functioning of the payday lending industry, among other things. So we're looking forward to hearing from her. And Devin Fergus is a fellow at the Woodrow Wilson International Center for Scholars and an assistant professor at Hunter College. He's currently finishing a book called Land of the Fee, which explores the rise of inequality and the transformation of the financial services landscape, how it affects low-income minority communities and other target population. And actually, the book is also going to be the basis of a documentary film that's in production now. So that's the lineup. I was told to maybe having 6 people on stage at one time would be a challenge, and I said, no, I want these people. They have a lot to offer, and here they are. So with that, let me start by turning it over to Tim to begin. Yeah, you should move the mic around so you speak into it.
Can you all hear me?
Yeah.
Good morning, everybody. Thanks for coming out, and thanks to Reed and New America for putting on this great panel. I'm just going to talk briefly about some of the broader issues, and then I'll turn it over to everyone else who's much smarter than I am. Just to give you a sense of where we are today, it looks like the bill might pass. There are now 60 votes in the Senate since several Republicans have committed to the bill, Scott Brown and the 2 senators from Maine, Olympia Snowe and Susan Collins. Ben Nelson, the senator from Nebraska, the moderate Democrat, is doing his sort of usual game of wait and see. But regardless, we can expect the bill to pass this week and be signed into law. So that's a start. And I thought it would be good to sort of think about where we came from talking about financial reform, because when this sort of started to become a broad public issue, and a lot of the people here have been working on it for a long time, but when it came to the public consciousness in 2008, it started off with the housing markets and the subprime crash that we saw, and it went up throughout the financial system. And it's sort of ironic that when we started talking about Fannie Mae and Freddie Mac, which was the site of the first real legislative activity on this, it's not really even in the final bill 2 years later. I think when you think about this bill, the best way to characterize it is not necessarily as a Wall Street overhaul, and it's been one of the debates that we've talked about, whether this changes Wall Street or it really changes the way the government regulates and supervises Wall Street. And I think you have to say that it's the latter. That doesn't necessarily mean it's a bad bill, but you have to recognize sort of the limits of its ambition. The bill looks a lot like what the Obama administration released in June of 2009. They outlined in a white paper what they wanted to see, and it's very strongly informed by the experiences regulators had in the depths of the crisis trying to respond to failing banks. Tim Geithner, the Treasury Secretary, was at the time the president of the New York Fed and was sort of the point man on responding to a lot of the crisis. And he and sort of like-minded people from the Clinton administration and in the regulatory agencies like Sheila Bair, the chair of the FDIC, all really asked themselves, what did we need during the crisis? Let's make sure we have those authorities. And the bill reflects a lot of that. And that gets to sort of a second debate that underlined the entire discussion of the bill, which is between hard and fast rules and regulatory discretion. I think a lot of people who were pushing for reform of the regulators really wanted to see banks faced with hard limits on how much money they could borrow and how much risk they could take and how much capital they would have to keep in their accounts to protect themselves in the event of failure. And almost universally in this bill, there are no hard rules like that. Instead, what Congress has done is said to regulators, you have the discretion to do studies and make rules that you think will achieve these broad aims of reducing risk. And given the failures of regulators in the run-up to the crisis, it's no surprise that a lot of people are skeptical of that. And I think we'll probably talk a lot more about what the regulators are going to do in specific areas going down the line. The other thing I wanted to touch on was just the idea of loopholes and carve-outs, because even in this bill where it's very strong, and I think the Consumer Financial Protection Bureau, the CFPB, is one of the strongest parts of this bill, but at the same time it has weaknesses that will talk about exemptions for entire industries. And you see that in a lot of places in this bill. On the Volcker rule, which is going to bar banks from doing risky activities, has big exemptions. And going forward, I think one of the big battles is how regulators are going to delineate these carve-outs and where you can get them tightened or not. And that's going to be the real decision on whether this bill is effective. It's hard to say right now whether it's going to really change things until we see what decisions regulators make. And I just wanted to touch on one sort of policy item, because I think it might not be gotten to throughout, but it really reflects how this bill is proceeded, which is what's called resolution authority. I don't know if you saw the New York Times this morning, but Hank Paulson, who was the Treasury Secretary in the Bush administration, was looking at the bill and said that the resolution authority is one thing that he really wanted when he was Treasury Secretary. And what that is it's a way to take a failing bank, not just a state-level bank, but an investment bank with global presence, and put it through a receivership process instead of facing the choice that Paulson and Geithner did in the fall of 2008 between bailing out the banks, which is what they ultimately did, or letting them fail and go into bankruptcy, which we saw with the failure of Lehman Brothers, was of serious consequence to the entire economy. And so this authority sort of represents exactly what this bill is about, regulators getting what they say they needed to solve a crisis, but people from outside may think rightly that that's not enough reform. Just to talk about what's coming up next, in terms of financial reform, obviously it's regulatory rulemaking. There are 28 studies in the bill that regulators are going to do, and people are going to have to watch those and see what kind of rules they make and whether they really live up to the spirit of the law. There are big appointments coming up. There's going to be a new bank regulator at the OCC. They're replacing John Dugan, who was sort of widely vilified for his lax regulation in the run-up to the crisis. That's this summer. The new Consumer Bureau is going to need a director. People talk a lot about Elizabeth Warren, who really was a chief advocate of the idea, being the director of that agency. And whoever is the director is going to have the ability to really set the tone going forward. And the other thing to think about, or one, is what to do about Fannie Mae and Freddie Mac, the GSEs, which are still very weak. They're not touched on in this bill, and if that comes up next year, as I think Republicans are going to want it to, it's going to be a real political firestorm, because it's not just the financial industry, but it's also how we subsidize home ownership in this country and sort of a long history of policies like that. And then the final question is whether, looking at this bill now, people who wanted more reform, like breaking up the banks, like a return to Glass-Steagall, like more restrictions on derivatives trading, are going to have an opportunity to push those policies forward in the years to come. And I think the one thing to keep in mind, as Reed said, is that this shouldn't be just one moment when we're talking about financial reform, but if we really want to do the job, it has to go forward over years of sort of arcane procedure. But if we want to stop a financial crisis like we just saw, it's probably what's necessary. And with that, I'll send it to
That was one of your headlines, right? Momentum, not a movement, or
movement, not a moment.
Movement, not a moment. That's good. Travis.
Good morning, and thank you, Reed and New America, for another excellent forum on this important legislation. I'll focus almost exclusively on the Consumer Financial Protection Bureau. As Tim mentioned, it is one of the stronger pieces in the bill. And to answer Reed's question, does it have the potential to change the game? Yes, potential. But everything has to work right. Overall, the legislation as it appears poised to pass, we hope, Ben Nelson willing, it is fairly strong. As Tim mentioned, it's got a few weaknesses, which I'll mention. But big picture, it's a major new agency that's well-funded, that's autonomous for the most part, that has broad power, and could make a huge difference for consumers in the financial services marketplace. So what I'd like to do is sort of put some meat on the bones, tell you generally what kind of funding, leadership, and powers it will or could have, and then lay out a couple at the end of my remarks, lay out a couple of issues that we hope will be on the policy agenda for the new agency. So let's start thinking in terms of opening the doors of a new agency, which is really exciting. As many of you know, this will not be a standalone agency. It will be an independent bureau within the Federal Reserve. Important to note, the Federal Reserve will have no operational authority at all over this agency. The agency could have its rules vetoed by the new Systemic Risk Council, but only if their consumer protection rules threaten the financial stability of the deposit insurance system or the financial system. I've quizzed my colleagues, academics, advocates, experts, legislators for the last 6 months. Can you think of a single example of a consumer rule that would, rather than making, improving systemic risk, improving the situation for consumers and the economy, but actually threaten the stability of the financial system. And to date, not a single example. So it seems unlikely that this new bureau is going to legitimately, at least, be challenged for threatening the stability of the financial system. Funding will be approximately $450 to $500 million a year provided by the Federal Reserve. The agency can ask for additional funds if it maxes out on that amount from Congress appropriations. Timeline. Agency has to be operational in 6 to 12 months. It can ask for an extension of up to 18 months. And the Treasury Secretary is going to basically set a transfer date, set this date, this open the door date, within 2 months of enactment. Leadership, as Tim mentioned, single director, presidentially appointed, Senate confirmed 5-year term. Obviously a huge appointment. Just as Joe Kennedy was essential to the Securities and Exchange Commission in terms of making it a vigorous regulatory agency in the 30s, this appointment will be that important for the Consumer Financial Protection Bureau. We need an experienced, vigorous leader with vision, with strong consumer credentials. There's no more important appointment in the bill. And as Tim mentioned, the OCC appointment is also crucial for consumers. Even though we're now separating functions, we'll have a consumer regulator. The OCC will regulate safety and soundness of national banks to ensure that bank regulators work in sync with consumer regulators, that we all row in the same direction from now on. That appointment, which will come over the August recess or in September, will be a crucial sign of the Obama administration's commitment to consumer protection. Jurisdiction of this new agency: credit, deposit and payment products, payment systems, debt management, all the debt products. Any of you stay up late at night and watch cable television? Those people who are promising to reduce your credit card bills by 50%, they're covered. Will the states have some authority to put consumer protection laws on the books that affect national institutions? Short answer, more than they have now. Not as much as we'd like, but more than they have now. Specific functional units will have to exist under the statute for research, community affairs, complaints. We'll have offices on fair lending, financial education, military consumers and older Americans, a private student loan ombudsman. So, big question. How much authority will this agency have to write rules and enforce them? Big picture, they're going to have authority over all lenders. To the issue that Reed raised, it doesn't matter what you call yourself. If you're lending, if you are covered by the jurisdiction of this agency, the agency is going to have authority to write rules, except auto dealers who loan money and some merchants. Senator Snowe got a very troublesome provision that will give small businesses and potentially small abusive lenders, like payday lenders, a sneak peek at rules by this new agency. We're very concerned about that, and we're going to work to mitigate its impact. Enforcement and examination, authority over large banks, most non-banks, so payday lenders, private student lenders, mortgage lenders that aren't banks. They'll have authority, but not small banks. Completely exempted from enforcement. This isn't rule writing, folks. This is enforcement and examination authority. That will stay with their existing bank regulators. So, what could this agency do? We're developing our agenda right now. Overdraft loans, abusive bank loans. This is, $35 for, $4 cup of coffee. Federal Reserve's put some pretty good rules on the books, but there are a number of places that this agency needs to go further. A number of abusive techniques used by banks when lending in the overdraft capacity. Payday loans. Leslie's going to talk about that. New mortgage lending requirements in the law. Credit cards. We're already seeing credit card issuers evading or simply disobeying the new Credit Card Act. As Reed mentioned, it'll have authority to create model consumer disclosures and will be required to create a consumer disclosure on real estate closings. Emergency savings. We'd like to see the agency address the need for emergency savings, which will help mitigate the need for many consumers for abusive small loan products like payday loans or overdraft loans. Research. This is one of the big unspoken tasks of this agency. It's in the legislation. It's very vague. If this agency is out there on a proactive basis, looking at the financial services market, examining things like default rates, delinquency trends, and other measures regarding credit affordability and sustainability, fair lending, access to credit, access to mainstream financial services by a number of demographic groups that we in this room care about, savings. That will have a huge impact on the marketplace. It will inform its rulemaking, its enforcement, but it will also inform its education and outreach efforts. And don't forget, this agency will be dealing with complaints. Complaints aren't just complaints. Complaints are information about what's going on now in the marketplace. If you use that data and analyze it, it will help this agency be more than just a reactive consumer protection watchdog. It'll be out there at the front of the marketplace, helping consumers deal with practices before they get too damaging. I'll stop there, and we'll talk more later. Thank you.
Thank you. Heather.
Sure.
Grab the mic.
So happy to. When Travis, who's one of my great friends and colleagues in this fight and has been for quite some time, really, led up the team within Americans for Financial Reform, which we haven't mentioned today, but is the broad single coalition representing over 250 organizations fighting for real financial reform. He and Ed Mierzwinski sort of led up the consumer protection team, and it was, and I think is probably one of the strongest pieces in the bill. I had the misfortune of leading up the Systemic Risk and Resolution Authority team, which I think, and have been saying for some time, very much to my dismay, is one of the weaker parts of the bill, because it really was tasked with trying to prevent another financial crisis, really was tasked with trying to actually end too big to fail, and to do more, I think, than what was, unfortunately, exactly what Tim was mentioning, the regulators' goal at the beginning of the design of this bill, which was basically just to give the regulators the tool to sort of, once a crisis was happening, sort of swoop in and fix it and preserve the system. Whereas I think that a lot of the organizations and commentators who circled around Americans for Financial Reform and have been engaged in this process really wanted to not preserve the system, but in fact change the system, the financial system. And I just want to take a minute and sort of explain what that financial system is that we are currently living with in the United States and globally, and sort of how the bill addresses some of the systemic risk portions of problems in the economy, and then how it doesn't. So basically, I'm sure that most people in this room know that Glass-Steagall was effectively repealed in 1999 with the Gramm-Leach-Bliley Act, but of course was chipped away at for the whole sort of 30-year period of the sort of reign of the anti-regulation ideology here in Washington and on Wall Street. So since 1999, which really was not that long ago, it was about 11 years ago, we've really seen a radical shift in the way Wall Street operates. We've seen much larger banks, much riskier banks, much more interconnected and over-leveraged banks, where the business model of the Main Street Bank and the Wall Street Bank really converged, which meant not only were Main Street banks, or sort of ATM banks like Citibank and Bank of America, acting like Wall Street banks, acting like hedge funds, owning hedge funds, taking hedge fund-like risks in the market, but also Wall Street sort of just pools of capital, basically, were acting like banks and being major intermediaries in our credit markets. So those were the non-bank sort of shadow banks, be they AIG, a big insurance company, or the mortgage finance companies that wreaked such unregulated havoc in our mortgage marketplace, because they really were outside of the bank regulatory system. The bank regulatory system was not at its best because you really had a dominance of an ideology that said that markets can police themselves. But then there were just major parts of our system which didn't even have just basic capital standards, didn't have anyone in government peering into their books. And then, of course, they had a lot of hiding and cooking debt off of their books. So that was the sort of picture. We had banks really relying more on short-term, volatile, non-deposit funding, which was really interconnected contracts, be they derivatives or repurchase or repo agreements, in and among other Wall Street banks and Wall Street players that were not banks. You had incredible amounts of leverage, which was in a large part because you had big banks like Bank of America competing with the investment banks, and the investment banks said, "Hey, if they're going to be in my sandbox, I need a lot more money." And the most profitable way to gamble is to do it with debt. And so you had the SEC in 2004 relax the leverage ratios that was for the top 5 investment banks. So you had firms having as little as $1 in capital for every $50 in debt that they had in the markets. And given that the instruments and the securities that they were gambling with were so weak because they were based on fraudulent loans and based on a real mismatch in our housing market, it was a recipe for real failure. And to the credit of a lot of the people in the consumer world here in Washington and in communities, we did see it coming. It is a total fallacy that nobody saw it coming, except for people who took a big short. There were a lot of people who very much saw that this was a really toxic cocktail waiting to explode. So the question of seeing what happens, how would we go back and prevent it? How would we fix it? The approach the bill takes is not to end too big to fail or too interconnected to fail by, very much as Tim mentioned, by putting hard limits, hard size caps, although there was the Brown-Kaufman bill, that amendment that would have put a size cap on the largest banks based on their non-deposit liabilities, so really their risky sort of capital market funding at 2% of GDP. Bank of America right now has 1/7 of our GDP in non-deposit liabilities. So that's not in the bill. What the bill does is it creates a council of regulators headed by the Treasury Secretary, and then designates the Federal Reserve as the systemic risk regulators to sort of carry out what the council of regulators suggests. But the Federal Reserve can also do its own regulations as well. Asks this council to designate a group of financial institutions, be they banks or, fortunately, and this is hopefully a real lesson learned, be they shadow banks as well. If you are large and interconnected, and if your failure could cause a distress to the greater economy, you will be regulated in this sort of category of systemically important. I call them systemically risky, but systemically important financial companies. And the Fed is mandated to issue tougher leverage, liquidity, and capital standards, as well as some other regulations, some other prudential standards. So it could and should create sort of an internal tax on size and riskiness instead of a real cap on size and riskiness. The Fed has to create these tougher standards for this category of really too big to fail firms than applies to other financial firms. So that is a strength of the bill. It is, there are no numbers, but it is a mandate to the Fed to make it for the first time actually more expensive for these firms to be bigger and riskier, because as we know, the market rewards the biggest and riskiest firms today. This question of what kinds of shadow banks, tomorrow's AIG, tomorrow's unregulated mortgage finance company, tomorrow's GE Capital, all sort of bailed out shadow banks. What kind of shadow banks are going to come under bank-like regulation? There's an element of the bill that just really gets me very upset, which is that there's a last-minute amendment to create, for this question of what is a financial company that's a non-bank financial company that could be subject to this greater regulation, a ratio of 85% to 15%, 85% financial and 15% commercial, meaning that a firm that is, no matter how big it is, 85% financial in its assets or its revenue, if it's 84% in its assets or its revenue financial, could escape regulation altogether. That's something that is a distressing loophole. There's some anti-evasion language in there, but again, it requires regulators to make the case that there was the effect of actually evading. I can't talk about systemic risk without talking about the Volcker Rule, which, as we know, was sort of a late add to the design that was really showed the leadership of Chairman Volcker, who was sort of one of the old guard, who said that actually what this bill should be doing is trying to change some of the structure and how banks operate. And it is sort of a mini Glass-Steagall in that it says that banks with access to our depository insurance and all of that shouldn't be doing the riskiest trading. There was a last-minute attempt, successful attempt by Senator Brown from Wall Street, or Senator Brown from Massachusetts, to really carve out and allow banks to continue to own and invest their own money in hedge funds. And I'm sure there'll be some questions and discussion about the Volcker Rule, which has really become emblematic of this question of, are we going to change the structure, or are we going to sort of tinker around the edges of what is now our over-leveraged and interconnected financial system?
Thanks. Yeah, a number of issues there that I think we are going to try to get back to in discussion, and Mike can weigh in on some of them as well.
Sure. Can everyone hear me okay? Excellent. So I'm going to talk, this bill does a lot of things, and I'm going to talk about 3 practices that it regulates that are important for every part of our financial system. Whether you're worried about the health of large interconnected international conglomerates, communities that are poorly served with predatory practices, or pension funds that are just trying to invest for their investors. 3 practices are derivatives, securitization, and the ratings agencies. 3 very different things: 2 instruments and a type of agency. So to start with derivatives, most people are going to be familiar with the way derivatives blew up through AIG, though there are a lot of other stories that you should check out if you're unfamiliar with. One famous one that's becoming more popular is Magnetar, which was a very popular episode of This American Life, and there's a ProPublica story. It's in Naked Cap. It's in Yves Smith's book, which talked about how people created securities to short them. Arguably, and some people are still doing numbers on this, really inflating the housing bubble in 2006 when it was natural for it to start to decline, kept the party going in order to short it. That shows that something's very broken in the way financial markets work. There's a lot of other places that the derivatives market imploded. So what this bill does is it walks back some of the deregulation and non-regulation in law from the late 90s. Graham Leach Biley and CFMA, Community Futures Modernization Act, had laws that, broadly speaking, prevented the SEC from regulating swaps on, let me make sure I say this right, security-based swaps. So it says, okay, now the CFTC will require swaps that are over the counter or in the shadows. There's a lot of ways to describe it, but basically 2 people talking on a phone without a lot of centralized knowledge or margining, and it forces them all to clear. Okay, that's the first step it does. The second step is that it requires them, and there's a lot of exceptions, we'll talk about them in a second, it requires them to trade on an exchange or a swap execution facility, which is an exchange-like object. Okay, so For at a high level, and feel free to ask questions or talk to me afterwards. At a high level, requires people to put up money and capital to make sure that they can fulfill their contracts, and requires some price transparency. It says, obviously the prices at which these things trade is important information. The fact that AIG was writing credit at a very cheap rate, meant that they were kind of getting snookered a little bit, and they were being played for a game, and that caused them. As opposed to an earthquake insurance that's poorly priced doesn't cause more earthquakes. But systemic risk insurance, like credit default swaps are, if they're poorly priced, that increases the problems in the system. So there's a real reason for regulation here. Now there's a couple exceptions here. One is that, as you're kind of getting the sense from other places, this is a regulator discretion bill. So it's going to be up to the CFTC to determine what is an eligible swap. So that's our kind of first chokehold problem. So if you have someone at the CFTC who's, Alan Greenspan's, intellectual hair or something, then, we have a new problem where it would be very easy for the bill is very directful, but it also is easy to see a CFTC dropping the ball here. Second is an end user exemption that was introduced through the process. And this says, if you're a non-bank who is using derivatives for their own commercial needs, so the prime example is an airline hedging fuel costs. You don't have to follow these rules. Okay, how that's going to work in practice could become problematic. Is Cargill an end user if they run a derivative swap desk? Was AIG an end user? It's an insurance company. Like this, how that's defined will become a major political fight in the next couple of years. And the third has to do with that price transparency. Prices are information, and information's power, and power is money here. So the more they can keep. The more derivatives dealers can keep prices in the dark, the better off they are financially. Part of this bill says that all swaps, cleared or not cleared, even the ones that fall through the loopholes, will require some sort of public. They'll be stripped of their counterparty information, but they'll be made public, the volume and the pricing, but after a delay. How long that delay goes for will be another fighting ground. So expect people to want to be declared an end user, to say that their swaps are unique in a way that they don't need to be cleared, and that they want to hold on to the information that's in their prices. So those are going to be kind of three battlegrounds over the next couple of years at a high level for derivatives. Next issue is securitization. In general, we are living through the crisis of securitization right now, and will be for the next 2 years. Ask anyone who is trying to negotiate a mortgage modification and doesn't know who to talk to, and the people who they talk to don't know who to talk to. Right. Securitization in the middle of a crisis turned out to fail in quite a grand way, and that affects everyone. That's millions of homeowners right now are struggling through the fact that their mortgage is sliced up into 30 pieces, and they're sitting in 20 different countries. And the servicers have terrible, terrible financial incentives to make sure that they follow through on that. And a lot of people bought securitizations that turned out to be junk. So what does this bill do for that? It says, well, if you issue a security, you have to hold 5% credit risk. So long story short is that if this security blows up, you're going to take a hit too. Now, there's a lot of debate about how useful that is. Obviously, a lot of the people who were issuing securities blew up anyway, but their bonuses were cashed way before they blew up, and they were out the door. So, this is a very high level and end game fix for this. So this is kind of like the last stage of fixes. Another round of things it does is to make sure I write my notes right. They have to disclose asset level or loan level data to the people who are buying this. So basically, you see this with stories of AIG. They didn't actually know what were in the bonds that they were insuring. So they did not know. They thought that they were 80% prime, but they were actually 20% prime, and so on and so forth. There's a lot of stories about this. So another goal is to get as much information about the securities out there as possible, with the idea that people who are buying these are well incentivized to come up with methods and tools to decipher them and determine how much they want to buy and at what price. This will be kicked in large part to the SEC. And the SEC may do a very good job or may do a very bad job of this. Right when this system was created in the 1980s as part of the deregulation effort of the Reagan administration, it was made to be very market friendly, but that turned out to be very servicer friendly, very middleman friendly. And you see this a lot with consumer products more generally, is that the system we ended up with is not investors and people who bought these securitizations and people who ended up being securitized don't particularly feel the benefits of this. The middlemen made out very well. So how to transfer power, but securitization is still a very powerful tool, and I don't think it's going away, though right now it's in crisis. So how do you empower people on both ends with taking the middlemen and making them more of just a servicer, just a guy who kind of walks things from point A to point B? A lot of people talk right now is that if in the George Bailey Bank of portfolio lending, you would just walk to your bank and renegotiate your mortgage. You can't do that right now. The people you would renegotiate with are very well incentivized to make sure you can pay your mortgage. Right now, the people you talk to aren't. Maybe they're indifferent, maybe they're incompetent, or maybe they're paid when you mess up. So with that in mind, trying to replicate the banking system we used to have through portfolio lending into the securitization model is kind of one of the goals that a lot of reformers look to. So that will be a battle that's fought over the next couple of years. And the last piece of it is the ratings agencies. And there's a lot of stories, but not enough, of how the ratings agencies messed up. My favorite is, you can find, I'm going to blank if it's from emails from Goldman or emails from Lehman Brothers, but they talked about having to pick the good AAAs from the bad AAAs. In finance terms, AAA means same as cash. So that is the same statement saying you have to go through your wallet to find the good $20 bills from the bad $20 bills, right? From a market point of view, that's a disaster. And the fact that we had that engine running as one of the main arbiters of how this credit risk is resolved in our system is dangerous. It's very dangerous for all of us. So how do we approach that? Well, one is to take the ratings agencies are enshrined in law. That the law, many of the financial regulations we have, going back to the Securities Act and many others from the 30s, put a special role for the ratings agencies. So how that evolved mean that a lot of government agencies had to use the ratings agencies. The ratings agencies always had a conflict of interest when they were rating, say, GE debt in the 1950s. It was always an incentive to kind of skim a little bit. But the problem with a lot of these AAA securitizations, if they weren't AAA, they would have never been created. A generic corporate company may have had an incentive to take someone out to dinner to try to get a better rating, but they could still issue debt at the lower rating. If these securitizations weren't AAA, they would have never been sold, or certainly never been sold the way they were. So taking that and try to bring it out of law is important. The other thing is to remove some of the special legal protections they have. There's several rules that basically say they can't be sued, broadly speaking. We try to make them more to look like registered public accountants. So people who, if they feel that they can't necessarily hide behind free speech laws the same way. The courts are starting to move against the ratings agencies on that, and I think you're going to continue to see that. So that still kicks the ball because we still have this problem with our government pensions and government agencies need a way to issue or to rate debt that they're going to hold. And if they're not going to use the ratings agencies, well, what will they use? Well, they'll tell you in 2 years when some studies are concluded. And that's a little worrisome because it's a very difficult project on how to do that kind of stuff. So with that in mind, those are three pieces that you should not overlook when looking at any part of the financial bill.
Great. Leslie.
Well, thanks to Read in New America for holding this event. And I'm going to basically circle back to the CFPB and expand on some of Travis's comments. My organization, one of our top priority was really making sure the CFPB was enacted as an independent agency, or at least an independent entity within the Federal Reserve, and that it covered all institutions. And I want to, in particular, drill down into the non-bank lenders that it will cover. But first, I want to put in a little bit of a plug for another part of the financial reform bill, which is it will enact new protections on mortgages and crack down on some abusive practices that really kind of started this whole financial reform process in the first place. And so I'd be happy to talk about that during the discussion as well. But as far as the non-bank lenders are concerned, they waged a very tough fight against the CFPB, and in particular, just the fact that they would fall within the CFPB's purview. They argue that they weren't the ones causing the financial meltdown on Wall Street. They were just making $300 loans on Main Street. Well, in reality, those $300 loans caused financial crises for families across the country. And there are some important steps that the CFPB can take to ensure that small loans help families weather financial crises instead of miring them in longer-term debt. And so I'm going to use payday loans as an example as kind of a poster child for some of the practices that have gone on in the non-bank small loan market. So I'll just give you a brief description of what they are. Payday loans are small, short-term loans that are due on the borrower's next payday. They come with fees of about $15 to $20 for every 100 that you borrow. And so for the typical 2-week loan, that works out to an APR starting around 400%. And on your next payday, basically you need to pay the loan back plus the fees from a single paycheck. So it's a relatively simple structure, but it's really a recipe for disaster for most borrowers. It's hard to imagine a borrower who's already living on the financial edge being able to pay back hundreds of dollars from a single paycheck and still being able to meet their regular expenses. So what we typically see happen is that they do pay back their payday loan. It's time to be due on their payday. So they have cash that day to repay it, but then they don't have enough funds left over for the rest of their pay period to buy groceries, pay for transportation costs, for healthcare expenses. So then they need to take another payday loan, and that cycle continues pay period after pay period with them paying a new round of fees each time. And the long-term consequences that people have found when they compare payday borrowers to similarly situated people that haven't taken a payday loan is a greater risk of bankruptcy, higher default rates on credit cards, trouble paying bills and other expenses, and losing bank accounts because they've become excessively overdrawn. 16 states and DC have been alarmed enough by these practices that they've essentially driven it out of their states by basically ensuring that payday lenders and other high-cost lenders have to follow the same interest rate limitations that other lenders in the state have to follow. And those are generally set around 36% APR, but it varies by state. Congress has enacted a rate cap to protect members of the military from payday loans and other high-cost debt. And they did this after they became increasingly concerned that soldiers were losing their security clearances because they were so indebted to these types of lenders. Now, the CFPB is not allowed to set a similar rate cap for all Americans. It's actually expressly prohibited in the Act. But they can do a lot of other things that can crack down on these abusive practices in other ways. So I want to just go through 3 of those right now. First, they can ensure that short-term credit products don't become long-term debt. And they can do this by limiting the number of loans that lenders can make to each borrower per year, at which point they would have to offer some sort of more suitable product if they wanted to offer anything at all. The FDIC a few years ago became concerned that banks were partnering with payday lenders, and they ruled that banks couldn't be involved in that practice unless they could ensure that those borrowers were not indebted to payday lenders for more than 90 days in any 12-month period. And that's the equivalent of 6 payday loans a year. So the CFPB could look at adopting that type of standard and apply it to all types of short-term lenders who claim their product should only be used on an occasional basis anyway. More generally, though, people facing financial emergencies may need access to small loans, but they don't need those loans to be due in a very short time period. So being able to pay back a loan in smaller chunks over time is really critical. There was a small loan pilot program that the FDIC just wrapped up. And one of their key findings from that was that people need several months to recover from a financial emergency and repay a loan. So the CFPB could take this finding and perhaps set a minimum loan term of, say, 90 days. Or they could do something where they said, for every $100 you borrow, you get a month to pay it back. So if you took out a $600 loan, for example, you'd have at least 6 months to repay. A final idea, which is probably not that groundbreaking but pretty critical, is that lenders should have to consider the borrower's other obligations when deciding how much they can afford to pay back. Many of the high-cost lenders, like payday lenders, car title lenders, only look at your income stream. They don't look at what your other expenses are. And that's because since they time the loan to be due on your payday, it doesn't really matter to them what your other expenses are. You're going to pay that loan, but your other creditors may suffer, or your other obligations. So even if it's a very rudimentary standard, just having some basic underwriting that also encapsulates what your other obligations are is pretty key. I think in a perfect world, ultimately, we'd really want to create ways for all families to develop emergency savings accounts so that they aren't dependent on small loans when the next financial emergency or financial shortfall hits. And I'm glad Travis brought that up because I think that's a really critical point to stopping the demand for some of these high-cost credit products. But while we're getting to that point, we need to ensure that these small loans are really a bridge to help someone through a financial crisis and not dragging them down further into debt.
Yeah, savings is a nice way to mitigate risks at all levels of the economy, both in Wall Street, capital requirements, and also at household level. Devin.
Thank you again, Reed, for inviting me and sharing this panel with my colleagues here. I'm going to focus really on three themes or major headlines I see, or motifs I see throughout this legislation. I'm a historian by profession and training, and so I'm going to try to use the past to inform the present as well as the future, just the way many Main Street lenders did in the recent CFPA. And people have short-term memories, and so we must strike in order to shape policy and to create a regulatory policy. You must strike quickly before the operational space for regulatory reform closes. And again, so I'm focusing on three themes. The first theme is what previous models exist that might be useful in creating a CFPB, a bureau, you might say. Secondly, the nexus between Wall Street and Main Street, and the ways in which, and again, as a historian for me, it's quite fascinating, the ways in which lobbyists and others rewrote the past, not because they were concerned about the past, but were concerned about promoting profit and protecting market share. And thirdly, a small but I think growing theme, and that small and growing theme is the impact this policy, this law might have on traditionally underserved communities, and perhaps blowback that might exist with this bill, something called Section 342, which has gained a lot of traction in certain quarters, but is invisible in the so-called MSM, mainstream media. And so what models might serve as a useful function here? And some of us sort of talked about it. Securities Exchange Commission, SEC, and FDR and Kennedy didn't really get along, and FDR loved to put Kennedy down. But again, the Securities Exchange Commission might serve as a useful model. And FDR loved to tell a story about how people coming out of a storm cellar, forget that they were ever in a storm. He tells his story in September 34 in presidential address, and he tells another story, right? How this parable he likes to tell about this wealthy man who was on a pier and falls off the pier and almost drowns into the ocean, and is saved by a commoner. And this commoner saves this man, but the man did not save his silk hat. And so when he saved the man, the wealthy individual thanked him and praised him profusely for saving his life. Yet years later, he came back and attacked the man for not saving his silk hat. And the moral of those parables that FDR told was strike and strike fast as you create this new policy, because people have short-term memories. And this is precisely what the SEC did after the Securities Act is passed in 1933. And then the Securities Exchange Commission is sort of created in 1934, headed by Joe Kennedy, and has clear and strong regulatory charges, right? Full disclosure. That was the initial charge, right, they had. And also the creation of an independent auditor, which uses a sort of standard auditing practice. And he put someone in charge who had legitimacy among individuals. And the same thing might seem sort of different, a weird sort of comparison, but perhaps even more apt comparison is Richard Nixon's creation of the Environmental Protection Agency in 1970. Again, another example of a strong individual with respect among his peers and subordinates. And because this individual was so well respected, he was able to create this policy. That person was William Ruckelshaus. Again, he's named the head of EPA in December 1970. Ruckelshaus, strong among his peers, he was House Majority Leader, right? But Ruckelshaus was also a member of the Environmental Defense Fund, so very well respected among his peers, both across both party lines, right? Ruckelshaus in the 1990s is appointed by Bill Clinton. Ruckelshaus, again, a lifelong Midwestern Republican. Right? Ruckelshaus, again, in 2008, votes for Barack Obama. Right? So respected across the party lines. And Ruckelshaus is also the victim of Richard Nixon in that famous Saturday Night Massacre. Right? Ruckelshaus refuses to fire Archibald Cox. So a man of impeccable integrity, well respected among his peers. Or individual of impeccable integrity, well respected among his peers and subordinates. And this sort of person, again, is the kind of profile. I'm a historian, so I don't necessarily project the future, but I can sort of construct perhaps past profile. This kind of individual was critical for EPA's early success, and Ruckelshaus sort of talks about his early successes in banning DDT, right, this sort of pesticide, as well as helping to clean up the water supplies, water pollutants in places like Cleveland and Detroit and Atlanta. Again, so the need for a strong, well-respected individual to lead the organization is quite important. And secondly, this sort of nexus between Main Street and Wall Street, and this sort of nexus plays itself out twofold. During the, you guys well know this well, during TARP proceedings, debates over TARP, right? Main Street, auto lenders, they go to Congress and they lobby for TARP support. And the argument is, right, that these industries and fields and markets are inextricably linked, right? And so when it serves the benefit of purpose, they argue that these industries are inextricably linked, that nexus. Yet, in this recent regulatory debate, when it came to regulatory oversight, Main Street wanted the exact opposite. Say, no, we aren't linked at all, right? That these separate as the fingers, one as the hand, right? Totally independent and separate entities, the Wall Street and Main Street. And in part, they were able to have it both ways because they constructed a plausible narrative, and that plausible narrative was that that Main Street has no role to play in Wall Street. And it also passed in large part because so many elected officials are quote unquote in the pockets of Main Street lenders, auto dealers, which are in every congressional district and play a critical role. And so again, the ability to bury that history and past and linkage between Main Street and Wall Street, and well documented. As we said, I'm working on a documentary film, and well documented by the Defense Department and others about the ways in which auto lenders and payday lenders targeted members of service members in the United States. So well documented that linkage and support in the ways in which they drew funding from securitized markets. And I'll keep it brief and keep the third and final point is something which is, again, at this point, largely hidden, but increasingly a growing thing about the impact of the CFPA, perhaps in, again, traditionally marginalized communities, underserved communities of color. I'll say this one thing from conversations I've had with regulators. They're CRA examiners, Community Reinvestment Act examiners, who are a bit disappointed that the CRA is going to be housed in safety and soundness, right, as opposed to being part of the bureau. And so in safety and soundness, they almost serve as a sort of second, a stepchild for that aspect. And safety and soundness is primarily concerned about the profitability of business, profitability of banking or banks, and not necessarily about consumer protection. So one impact, again, this might have on traditionally underserved communities is in the Community Reinvestment Act, again, which serves not simply inner city communities, but also rural spaces, rural America, and also reservations as well. So Appalachia, Alaska, as well as reservations in Big Sky country. But again, a small but growing, I think, concern might also be Section 342, which is in this new act. And Section 342 calls for the creation of the Office of Minority and Women Inclusion, offices of minority and women inclusion within 20 federal agencies. And so as well as within the Bureau. So basically, within the SEC, within the Federal Reserve, within the OCC, the OTS, there's going to be these creation of these offices of minority and women inclusion, and the concerns which are being raised in certain quarters is that this is simply a gender and racial quota system, and they point to language used in this act, and that language basically talks about the maximum extent possible for fair inclusion of minorities and women in overseeing regulations, and they point to that language as language of creating a racial quota and gender quota, but historically speaking, again, as a historian, we need to put that language in context. Reed talked about this being the most important regulatory policy since the New Deal, and anyone who knows New Deal history understands that what happens in Washington what happens in Washington is not necessarily what's going to go on in localities, municipalities, and counties across the country. Agricultural Adjustment Act, you can go all through the alphabet soup of New Deal policies, as well as the GI Bill. And these laws get passed in Washington, D.C., but the way they get implemented on the ground are disproportionately discriminatory against racial minorities. And so in looking at this Office of Minority and Women Inclusion, again, you take that historical narrative into account. And you also take the narrative of the 1960s into account as well. Again, they point to this language used in the Office of Minority and Women Inclusion as language of racial quotas. But again, the language is the maximum extent possible, which sounds a heck of a lot like maximum feasible participation, right? Which is, again, a language of the 1960s, which is not necessarily about race, but is also about inclusion of class and people of various class backgrounds. And again, the language of racial quotas is a language of the 70s. But this language, anyone who knows, has this understanding of history, knows that this seems like more like the language of the 60s, which is about maximum access possible. And again, there are no hard, fast numbers or figures in Section 342. Yeah. And I'll leave my comments there.
Yeah, thank you. A lot of great material there, and I have a series of questions, and you also might have some questions for each other. I'm going to invite you to weigh in and kind of flag down when you want to highlight something. I say that with a lot of the comments, that there's a lot of could, shoulds, and unknowns, and I think that's really a product of the bill's preference in a number of cases for this discretion over dictates, over the hard rules. And I guess I have a question broadly about how we're going to kind of prompt action among these new bodies. And I'm thinking of both kind of regulators and some of the other entities that are out there, both the Bureau on the Main Street side, but also this Oversight Council. And what will it take to kind of prompt action? Should we be watching them closely? It seems like the Council of Oversight is going to have a lot of the usual suspects, the leaders of the regulators, the Fed, the Treasury Secretary, where leadership matters a lot with the rollout of the Bureau. And certainly with all of this, we're concerned with regulatory capture, this phenomenon where oftentimes the regulators end up working closely with industry, maybe to the detriment of the system. So I'm looking for ideas on how we address some of these issues, both in the rollout and how we prompt action among these different regulators. Thoughts? Travis?
It looks like Tim as well. So I'll throw out a couple of ideas. I think the golden rule when it comes to consumer agencies, and we could talk about the Consumer Product Safety Commission, the Federal Trade Commission, the Food and Drug Administration, ostensibly a consumer protection agency when it comes to, say, drug safety, is leadership trumps everything. You can have a good law, you can have a strong nonprofit and advocacy community out there, urging the agency to do the right thing. And if the agency is game, then good things happen. And if they're not, it's very hard to make them do it, especially if that direction's coming from the top, from the president. So first step, obviously, good leadership. I do think the active effort in the nonprofit and advocacy community that Heather described, which includes this Coalition Americans for Financial Reform, is going to be helpful. Let me just describe one of the problems. When you go to implementation and rulemaking, it's the difference between fighting a short but intense battle. In this case, the battle has been 2 years, and sort of long-term trench warfare. Think, an 8-year World War I. It's very difficult. It's very resource intensive. Industry often has an advantage. And it's going to be very important for us to, marshal our resources, choose our battles, and focus when it comes to the consumer agency, derivatives, systemic risk regulation, et cetera. We're going to continue to have to work together because it's going to be hard.
I think Travis said it better than I could, but I would just note that there are some signs that we do have that leadership. I think Sheila Bair, who's the head of the FDIC, just announced that she's going to be webcasting all of her committee's meetings on these issues. She's going to be setting up a new website to bring transparency to the rules, and they're going to release, I think for the first time publicly, all of their meetings with everyone, including people from the industry. So hopefully that'll set a tone for other regulators to be similarly transparent in the really arcane sort of rulemaking process that'll give people who are advocates something to sort of latch onto in terms of advocating for taking all of the potential that's in this bill and making it a reality.
And one more thing to think about follow-up is, if you look at other big policy initiatives, take No Child Left Behind, you have hundreds of experts who will go on television and tell you how it's working and how it's not working. And what's interesting is the way they define it working is a political judgment, and it often shapes the whole narrative the way it is. It's test scores and low cost and choice. So we need to develop language to determine whether or not this bill's working, especially at the high-end systemically risky portion of it. Just framing the way in which this bill is or is not working. Is the 6 largest firms becoming bigger but having more capital a win? Do they need to shrink because we want to engineer more competition? Just thinking, should this look like a public utility ultimately, or should this look like the Wild West where everything blows up every other week? Just the way we think about how this is working and then how we follow through and judge it quantitatively and qualitatively will have a lot of power in shaping the narrative of how this bill unfolds. And I encourage people to think about that.
And I see that certainly working on the Consumer Bureau side, but I'm a little concerned about with the systemic regulator. We know who these actors are. We're going to get a new appointment for the OCC now, but we know they are. Do they have a secret plan? What is going to trigger action? They say they're waiting for the international Basel agreements. They say capital requirements are going to be one of their major tools. Do we believe them? This bill gets passed. Do they immediately go around and say, guys, you're going to have to increase your capital levels here, and obviously that will have an effect of pushing down the size? I mean, has it all been there in front of us all along, or what will trigger action with the council? Heather, Mike?
I think that's a really good question. In some aspects of the bill, there is a time limit on when the council has to come up with recommendations and when the Fed has to act. I think definitely they've been saying waiting for Basel, sort of this waiting for Godot thing, and I think we don't have a lot of confidence that the international regulators are going to be the ones to lead us out of the dark ages, that we really are going to have to lead on our own financial institutions. I think it will require public pressure and combing through the SEC reports of our largest banks and really holding accountable and publicizing the numbers and saying where's the change. That said, I do think that we can be confident that there are reform-minded regulators who really want substantively higher capital requirements. I mean, the FDIC's role in the so-called Collins Amendment, which really asked for tougher capital requirements than there are today, that asked for the bank holding companies that own the banks to also have tougher capital requirements so that the conglomerates are not actually sort of are actually the source of strength for the banks and not the other way around, that asked for better capital, and so that trust-preferred securities, which are basically a debt instrument, are not being counted as capital. That came from the FDIC, and so you do know that there is sort of a little bit of a war, and it does come down to leadership. There is a little bit of a war among the different regulators, and it's going to take a 2/3 vote of this Systemic Risk Council to take action on some of these pieces. Now, the other important sort of counting heads note is that for many of the major decisions that the Systemic Risk Council has to make, there is an effective Treasury veto. The Treasury Secretary, who's the head of the Systemic Risk Council, has to assent. It's a 2/3 vote with the affirmative vote from the Treasury Secretary. So leadership does matter.
Mm-hmm. Did you have things to add?
A couple of things. I agree with what Heather said. Another thing is how many studies were there? There's like 28 studies. There's a couple dozen studies. But in most of the studies are things that are controversial, or things that the banks do not naturally want to do. Issuing contingent capital, for instance, is a very well-known one. The Franken Amendment with securitization reform, with ratings agencies reforms of rating securitizations. Now what happens is these studies will still be done, and they'll be there. And so if there's another crisis, or if another part of the financial sector fails, even if the regulators do not implement these things, there has been studies, there has been one of the things I think, especially 2 years ago, and people got a lot better on this as we went forward, is that people were often frustrated that there's a cynicism with trying to deal with the financial crisis, that the financial lobbies are so powerful, and they dominate the terms of the discourse that takes place. We're still arguing as if we're in Milton Friedman's graduate seminar, talking about how great the free market is, but it might fail over here. And so having a couple dozen studies that are well prepared of good ideas, or at least ideas that could be very good, on the shelf to keep as part of the public debate will be helpful, even if nothing comes out of it in the short term.
Yeah. And there are studies are places in Washington where controversial issues go to die, as Mike says, but they can also be precursors for action. Two that I would point to, and Mike, tell me if you disagree on the Franken Amendment, is I understand it, the language on the study on whether regulators will develop a method to eliminate the conflict of interest Mike spoke about regarding the assignment of credit ratings requires action at the end of, I think, a 2-year period. So that's a good thing to look for in a study. We're actually fairly happy about the study on whether investors should have a fiduciary protection that the people who sell them securities directly are bound to represent their best interest, because given what's going on at the SEC, it looks like that study is going to result in action as well. So there are a lot of studies, and some are going to be just worthless pieces of junk that may someday be revisited when there's another crisis, and others may lead to action.
Yeah, it's worth mentioning that the CFPA was a democracy article like 5 years ago. That's right? Now it's made reality, and it has the potential to do a lot of
Not
good.
that long ago, actually. It was only a couple. I think it was 2007.
2006, and it was democracy, right?
And we actually had it in an early proposal form that we called for in our assets agenda, calling for a financial product commission, and it was picked up in the 2008 campaign by a number of people, including Heather.
So one thing I've noticed just writing online, a lot of things moved quickly just because people feel a need for reform, and they're going to continue to feel this. Homeowners are still going to be underwater. There's still going to be a crisis with foreclosure for the next 2 years. GSEs are not reformed. Basel might feel very nebulous. So I encourage people to keep thinking and keep writing, because I think there's still a vacuum and a need for conversations and for political action on this.
Yeah, I do. There's a lot of policy issues to get to, but on some of the politics that have unfolded here and how pressure has been brought to bear and ideas have gained currency, it's kind of interesting. I think some of the factors about how military families became a constituency in this debate, I'd like to hear Devin talk about. I'd also like some comments from the panelists on the Obama administration's performance here. The blueprint they put out last year in May was actually pretty close to a lot of what we got here at the end of the day. In fact, I think it strengthened in some places. Now, I'm not sure they've gotten credit for that, whether they deserve it, or what role they've played in the process. There was a couple of key moments where there were statements from the White House that said, look, the payday loans matter, and we got to make sure that they're still part of this, and some of the other concerns about these predatory products. And I thought they weighed in strategically. So assessments on the political performance of the White House and what it might mean, as well as some of the other political dimensions that emerge with military families.
Sure. With regards to the military family question, really, again, it ties into the question of financial lobbyists, auto lending lobby, burying the past. And so in winter, in February this past year, DOD comes out with a letter basically urging for passage of the CFPA. And the response to the auto lending lobby basically is that it's not a surprise that the Defense Department would support the policies and positions of the Treasury Department. Basically sort of arguing about this implicit political pawns of that the military is basically political pawns of the White House, when in reality, for the last 5 or 6 years, before Barack Obama ever thought about stepping on the presidential campaign, actually, the military personnel and defense have been actively calling for consumer protection policies. The Military Lending Act of 2005, for example. The bankruptcy law, and they tried to pass an amendment. The military tries to get an amendment to the bankruptcy law exempting military service personnel during the Bush years, but again, it gets sort of struck down. So well before Obama steps into the White House, the military has been actively engaged. And it's also, in many ways, foreshadows what you might see, because first the military creates, it's okay, we can't get laws passed. We create an Office of Financial Literacy within the military because we're going to make people more literate, service personnel more literate about the policies. Well, that largely failed. And so they go back to Congress looking for legislation to get passed. And if you think about it, again, bookends of history, Eisenhower in the 1950s taps the head of GM as head of the Defense Department, right? And now the auto lending industry, again, is really sort of at loggerheads with Defense Department as well. And it goes back to issues of public interest, executive compensation, which is critical to TARP, right? I mean, TARP funding says that if you undermine the public interest, again, you can have all kind of penalties toward executive compensation. So it goes, again, against notions of what it means to operate and function in the national public interest. It goes to that issue as well.
And among other things, the new Consumer Bureau will have this Office of Financial Literacy created within it that obviously we need to kind of figure out what they're going to do. But it is created by the bill. Did you?
Yeah, just on the politics question of how this comes out, I just wanted to make 2 points. And one is in relation to what we were just talking about with how fast things moved on these issues. It's sort of worthwhile when you're thinking about how much this bill achieved to compare it to healthcare reform. On healthcare reform, which was a sort of similarly big, politically controversial project, there had been decades and decades and decades of effort and thought and policy making. There was the 1994 Clinton debacle, but even in the Democratic primary in 2007 and 2008, it was a huge topic of discussion. There were any number of sort of coalitions and nonprofits around organizing, advocating policies, sort of laying the groundwork for a real legislative push. You had people in Congress who knew these issues well. And for financial reform, and again, despite a good-sized community of people working on these issues for a long time, the 90s and the 2000s were very conducive to sort of looking the other way while the financial sector grew and did the things it did. So you don't have that institutional hierarchy. You don't have those knowledgeable people talking about the issues and sort of laying the groundwork for real accomplishment. So while this bill may disappoint in a lot of ways that we've discussed, you also have to look at it as sort of a founding moment for stuff like the Roosevelt Institute, which hadn't really dealt with these things before but brought Mike on. Americans for Financial Reform is, I think, just barely a year old, or 2 years old. Was it in 2008, 2009? So, looking forward, we have, maybe more potential for a better articulated agenda on reform. On the question of the Treasury Department and the Obama administration, this is something that Mike and I have argued about a little bit. I think in general, while you saw the Treasury coming in at key points to push compromises they thought were necessary to get votes and also push back a number of times against hard limits on things in favor of discretion, I think overall they were beneficial. And I think especially where President Obama was influential on consumer issues, I think that was the one thing where the administration really held hard and pushed that issue forward. On a lot of other things where the administration sort of disagreed with reformers or watered stuff down, I think you're going to have to debate for a long time how you do the vote counting. But I think they honestly do have reason to believe that giving regulators discretion might result in better regulation. They're very skeptical of Congress, and it comes out of this sort of experience that a number of the top administration officials had, whether it's Geithner or Michael Froman in the White House or whoever, who feel that Congress doesn't take seriously financial crises. They think that Congress doesn't act quickly enough and doesn't appreciate the magnitude, and they trust regulators more. Now, I think from the outside that can look like not the best position, but that's why I think that explains a lot of their actions. I think Mike should weigh in.
I want to pass on giving a grade to the White House. Let me ask Travis, Leslie, Devin, others. This bill gets signed, let's say, next week, White House ceremony. How fast do things change on Main Street? How quickly does some of the business models of the payday lenders disappear? What will change that the business model? What will change the practice on Main Street? And will families see a difference?
Well, the broad timeline for action is, I think it's unrealistic to expect substantial action in less than 2 years from the new consumer agency. I would just add a reflection on what's going on in the marketplace right now. Mainstream credit in many situations has dried up. And so the issues that CFA works on and that Leslie talked about related to access to, quote, alternative credit and alternative financial services, payday loans, even overdraft loans, because the folks that we know, thanks to FDIC research, who use overdraft loans the most are, low and moderate income, often minority, often younger. It's the high cost, often short-term alternative loan vehicles that may benefit from the current mainstream credit crunch. And it's going to be an interesting challenge for this new agency, because on the mainstream side, it might be more focused on, sort of using the bully pulpit to look at ways to encourage access to credit. But on the alternative side, it's going to have to crack down on these abuses.
Yeah.
Sure. Yeah, I agree with Travis. It's going to be a little while before they can get up and running and really have the research to back up some of the actions that they're going to be wanting to take on these issues. And there's a full range of financial products and services that really need to be looked at, and they interact with each other. So someone taking a payday loan may also be overdrawing their bank account, and there's a lot of similarities with the abusive features of these products. So it may be a good idea at the outset to not look at each product in a vacuum, but really some of the underlying abusive features that are present in a number of products and how those can be reformed.
Sure, I'll weigh in briefly. Again, I think they're largely correct. But again, I thought about the example of EPA and Ruckelshaus. Within weeks, Ruckelshaus threatens to sue Atlanta, Detroit, and Cleveland if they don't clean up the toxins in their water. And so,
is he available to take this new position?
He may well be. So again, someone from up top laying down the gauntlet. But on the flip side, I think about, again, Tony Badger and his work and writings, and he talks about how critics of today of New Deal policy and post-New Deal policy ignore the fact that for over 50 years there was market stability that existed. Again, that begins to erode, as Heather and Mike sort of pointed out, in the early 1980s, first under Carter and then under Reagan.
So, Mike, Heather, same thing. This bill gets signed. What changes soon after on Wall Street and in the financial system?
Sure. Well, one point that I'd actually like to make is that we're not really going to see financial reform is important to changing our regulatory structure. But at the core question, these issues of, what happened both in the consumer market and on Wall Street for the past 20 years is really about structural weaknesses in our economy. You can't have families families that are making $35,000 a year living on their home equity as if it were an ATM card, living on payday loans and overdraft fees, if there aren't these structural problems facing them, being stagnant wages or rising costs in healthcare and transportation and the lack of childcare. I mean, that's really what made families turn to borrow to make ends meet. The fact that there was increasingly expensive and available credit was the sort of supply side, but we have to address these demand issues and pushing for policies that will increase the economic security of our households. And then largely also on the Wall Street question, why are Wall Street firms basically making debt investments in the indebtedness of people and the indebtedness of companies instead of in the productive sectors of our economy? And why are we not using all of that floating liquidity out there in the system to really be creating the jobs of the future? And why is it so much more profitable to do a credit default swap than it is to invest in a new company or in the new products of the future? So I think we can't have these conversations without talking about the greater structural concerns that are in our economy and that are not going away no matter what financial reform achieves or doesn't achieve.
So, Mike, can we take our Wall Street sector back to 1997, or do we need something better?
1993, I think, would be a better time machine target date. No, I think Heather brings up a lot of great points, like stagnant wages, the increasing financialization of the economy. So the way this was one of the frustrating things about the carve-out for firms that are only 15%. In the financial sectors, you have a lot of firms that basically got very interested in being mini banks. GE Capital is a classic one. GE is what used to make a refrigerator, but now basically makes commercial paper to supply subprime mortgages. How do you deal with that? How do you change the economy back to something that is how do you change it so the focus is much more on building the real economy as opposed to a financial economy that, the financial economy has to do one thing, and it has to basically move money to where it's most productive. And by any account, it spent the last 10 years completely failing in its job. It made trillions of dollars of worthless debt no one wants anymore. And that was very unproductive. It basically went to keep people with some form of credit card safety net through health insurance and increasing costs of transportation and housing. So how do we change that? I mean, that's not going to happen in the short term by any means, but I do hopefully think that this starts to get us on a path.
On a path forward. That's a great place to wrap up this morning, and thank you for coming. There's obviously much more to say on this. I want to pledge that we're going to have a lot more conversations here at New America on these topics, including next Tuesday we have an event with Gary Rivlin in his book Broke USA, which details the rise of the alternative financial sector and some of its underbelly. So you can join us for that, and thanks for coming.
Thank you, Reed.
Cheers.
Thank you.